We're diving into the world of covered call exchange traded funds, ETFs, with a specific focus on QYLD. Join us as we uncover the good, the bad, and ultimately, whether you should consider investing in QYLD. Section 1. Understanding QYLD. Before we delve into the pros and cons of QYLD, let's take a moment to understand what it is. QYLD is a popular ETF that stands for Global X Nasdaq 100 Covered Call ETF. As the name suggests, it tracks the performance of the Nasdaq 100 index while utilizing a covered call strategy. That is a two-part strategy in which stock is purchased or owned and calls are sold on a share-for-share basis. The Nasdaq 100 index consists of the top 100 non-financial companies listed on the Nasdaq Stock Exchange, encompassing sectors like technology, consumer discretionary, and healthcare. QYLD aims to generate income by selling call options on the underlying stocks within the index. Section 2. The good. Now, let's explore the advantages of investing in QYLD. 1. Income generation. QYLD employs a covered call strategy, which involves selling call options on the underlying stocks in its portfolio. This strategy generates premium income, providing investors with regular cash flow. In fact, QYLD has historically offered an attractive yield compared to traditional income investments, like bonds or regular dividend-focused ETFs. 2. Reduced volatility. By collecting premium income from selling call options, QYLD's volatility can be potentially dampened. This can be attractive for investors seeking a smoother ride compared to the underlying Nasdaq 100 index, which can experience significant price swings. 3. Exposure to Nasdaq 100. QYLD offers exposure to the top 100 non-financial companies listed on the Nasdaq Stock Exchange. This includes technology giants like Apple, Microsoft, and Amazon. By investing in QYLD, you gain exposure to the growth potential of these prominent companies, which have been at the forefront of innovation and have consistently delivered strong performance. 4. Lower risk than naked options. Compared to trading options individually, QYLD's covered call strategy mitigates some of the risks associated with naked options, as the potential losses are partially cushioned by the premium income. This can provide a level of downside protection during market downturns. 5. Covered call ETFs longevity. QYLD was established in 2013 and the covered call ETFs. Many of the funds have been around for 5 years or less at this point. It is good to be able to go back and research their payouts and stock performance. Before we get to the next section, check out the links in the description. And if you like the video so far, comment below, like, and subscribe for more investment insights. Now on to the next. Section 3. The bad. No investment is without its drawbacks, and QYLD is no exception. Let's explore the downsides of investing in QYLD. 1. Capped upside potential. Selling call options limits the potential upside of the underlying stocks. If the stocks experience significant price appreciation, QYLD's gains may be capped at the strike price of the sold options. This can result in missed opportunities for substantial capital gains. 2. Underperformance in bull markets. During strong bull markets, QYLD's covered call strategy can underperform the underlying index. This is because the call options sold by QYLD can get exercised, causing the fund to miss out on some of the upside potential. If you believe the market will experience prolonged bull runs, QYLD may not be the ideal investment choice. 3. Focus on income, not growth. If your primary investment objective is long-term capital appreciation, QYLD may not be the best choice. Its primary focus is income generation through the covered call strategy, which may not align with aggressive growth objectives. Investors seeking significant capital appreciation might explore growth-oriented ETFs or individual stocks. 4. Market risk. QYLD is still exposed to general market risk, including fluctuations in the stock market and the performance of the Nasdaq 100 index. While the covered call strategy can provide some downside protection, it does not eliminate the overall market risk. 5. Potential taxes. QYLD's covered call strategy can have potential tax benefits for certain investors at different times. In 2020, QYLD returns were given as return of capital, but as of today, it generally is taxed as ordinary income. It may change in the future, but it's probably best to consider QYLD and other covered call ETFs as being taxed as ordinary income. And think of it as a bonus if the ETF goes back to distributing returns as return of capital for a year or more. Section 4. Should you invest in QYLD? Now that we've weighed the pros and cons, let's determine whether investing in QYLD is suitable for you. 1. Risk tolerance. If you have a moderate risk tolerance and seek regular income, QYLD's covered call strategy can be appealing. The fund's reduced volatility and consistent cash flow can provide stability to your portfolio. 2. Income-oriented investors. QYLD is particularly attractive for income-oriented investors who prioritize generating cash flow. If you're looking to supplement your existing income or rely on consistent dividends, QYLD strategy can be beneficial. 3. Diversification. QYLD offers exposure to a diversified basket of Nasdaq 100 stocks, spreading risk across multiple companies and sectors. If you're seeking diversification within the technology sector, QYLD can be a valuable addition to your portfolio. 4. Investment horizon. Consider your investment time horizon. QYLD is more suitable for investors with a shorter to medium-term outlook, as its focus is primarily on income generation. Or longer term, only if you are not seeking growth through stock price appreciation. If you have a longer investment horizon and seek significant capital appreciation to sell for huge gain, other investments such as growth or blue-chip dividend stocks may be more suitable. QYLD presents a unique investment opportunity for those seeking regular income and exposure to the Nasdaq 100 index. While it offers advantages like income generation, reduced volatility, exposure to leading technology companies, and potential tax efficiency, it does come with limitations such as capped upside potential, underperformance in bull markets, and a focus on income rather than high growth. As with any investment, it's crucial to align QYLD with your financial goals, risk tolerance, and investment time horizon. If stability, income generation, and diversification are important to you, QYLD may be worth considering. So how much can you make from QYLD? Check out this next QYLD video to find out, and if you decided QYLD is not for you, check out our Blue Chip Ultimate Dividend Investing Guide playlist.